Welcome to the Money Tree Real Estate Investor Podcast, where we learn from real estate professionals across the industry. They will share about how they got into real estate, the big wins they have celebrated, the mistakes they have made along the way, and the advice they have for anyone following in their footsteps. Money really does grow on trees.
Hey everybody, it's William Holland here for another episode of the Money Tree Real Estate Investor Podcast. Today I've got a special guest, Dan Lewkowicz. He is living in the Detroit metro area. So Dan, man, tell us a little bit of your story and how you got into real estate.
Sure, yeah. So my name is Dan Lewkowicz. I am a commercial real estate broker. I specialize in net lease investment sales. So I sell things like Walgreens, CVS's, a lot of quick service restaurants like Taco Bell's, Wendy's, Burger King's. We do a lot of strip malls as well, shopping centers of all different sizes, medical office building, discount retailers like, your traditional dollar stores, auto parts stores, et cetera, et cetera. The common thread amongst most of the properties that we sell is that they're typically leased long-term to corporate tenants on what's called a net lease, which we can discuss, a little bit later. But in essence, the tenant pays for all of the expenses. They pay for the taxes, the insurance, the maintenance, the repair, everything. And the landlord receives, a rental check that's net to them with no expenses. There are exceptions. There are some leases that are called double net leases, where the landlord may be responsible for things like roof and structure and parking lot, still very minimal. And then obviously with product types like shopping centers, there's going to be more, landlord involvement. So, I first got involved in real estate actually back in 2005. I formed a company with some friends called Disability Made Easy. They're still running the company. It's a barrier-free home modification company that specializes in making homes handicap accessible for individuals with terminal illness or injury. And, I was involved in the sales and marketing at the time, but I also had some interaction with our project manager who would go on to, different sites. And I would go with him and see these properties that to me just looked, beyond salvaging, beyond fixing for the purpose, that their occupant wanted them. But, he would take a little sketch pad and a pen and some graph paper, and in a few minutes, he'd be able to design, an entire, new layout or new front facade of the building in order to help the individuals be able to get through the property as they're living there. And to me, it just kind of like emblazoned in my mind this idea of being able to take something that's outdated or functionally obsolete, renovate it and then sell it at the end. So that's kind of how I got my start. I started buying properties first, a home for my family at the time. And at the time, this was back in, the late, early teens, late, whatever you call the period before the teens. And, I bought a property from the bank that needed a lot of work, renovated it, lived in it for a few years, and then sold it. And then I went on and, at that point, I really fell in love with fix and flips, and I started buying more properties, renovating them and selling them. And then occasionally when an opportunity would present itself, I would, move into one of the properties myself, renovate it, stay there for a few years and sell it. And that's really how I got my start in real estate was through, house hacking and fixing and flipping. Very grueling business for anybody who wants to get into it, doing it one at a time. But, over the years that led to me working at a title agency, doing sales again and learning about the title aspect of real estate, all the while continuing to flip homes. I went on from there to being a business development executive at Amazon, again, doing sales, but on the side flipping houses. And eventually when I left Amazon in late 2017, early 2018, I went full time into house flipping, which was a great experience. An exciting experience, and one that I will probably never do again. But eventually from that, I transitioned pretty quickly into commercial real estate brokerage, which is, where I fell in love, and it's where I am today and where I'll be the rest of my life. I still do occasionally, flip houses on the side, but really my passion is assisting investors in the purchase and sale of net leased assets.
Yeah, I love that, man. I can just tell by that story, you have an entrepreneurial spirit and you like to hustle and grind. I can definitely see that.
For sure.
And I think that's what it takes in commercial real estate, especially in the environment that we find ourselves in today. You really have to scrap and, be willing to just keep moving forward, even though maybe you're not getting the results that you want to see right now.
Yeah, I look at it as the only variables that we can control are our inputs, right? And if the broader market shifts, in a downward direction, then the only remedy for that is to increase the inputs, right? And the outputs will follow. And I think that's such an important mentality to have in any industry, but especially ours, because if you let the market dictate what you do in terms of your mindset and your activity, but in a negative direction, it's a roller coaster, right? It's an absolute roller coaster. But if it's like you kind of just have the same fundamentals of whatever your fundamentals are of your day-to-day that you need to do to be successful, if you see a change coming in the market, all you need to do is dial that up a little bit. Don't change anything, right? Keep doing it, just maybe do more of it, right? So I think that's really important, especially in today's market.
Absolutely. So you're on the brokerage side of things. So how is the interest rates rising? The economic environment that we find ourselves in. What has happened to transaction volume and bid ask price between buyers and sellers? What type of things are you seeing in that area?
Great question. So overall, there's definitely, from what I've read, I see it, but also I like to read about it as well. But from what I've read, the major brokerage houses, the CBREs, the JLLs, the Marks and Millichaps of the world, they're all experiencing incredible slowdowns. Here at Encore, I would say that we're not experiencing an incredible slowdown in volume. But again, I'm watching the agents do the same thing I am, just dialing up that activity, right? Dialing up the amount of hustle that we put out there. Overall, the market has definitely slowed down in terms of transactional volume. We had a banner year in 2021. We sold $935 million worth of net lease properties. And then in 2022, we did $985 million. So, things definitely didn't slow down for us at the end of last year. This year, we felt, like I said, a little bit of a slowdown. But interest rates definitely affect our product type. And typically, or historically, I should say, we'll see a change in interest rate and then maybe a minor correction in pricing. But we haven't just seen a change in interest rate over the last 14 months. We've seen unprecedented, massive, continuous interest rate hikes. So, if you look at the 10-year Treasury, over the last 14 months, or you look at the federal funds rate over the last, 14 months, federal funds rate went from essentially zero to approximately 5%. That's 500 basis points in 14 months. And it's not going to stop. I think that recent, current events as it pertains to, major bank failures may slow the Fed down temporarily. But, Jerome Powell has said at every single Fed meeting over the last year that, they're not going to stop until they get inflation, back to 2%, which from my perspective is going to take some time. So as it pertains to your question about, buyer and seller bid ask gaps, as you called it, there's definitely some, what I call market dislocation. There's dislocation in the market between buyers and sellers. A lot of sellers are looking back and saying, well, wait a minute, I had, X pricing from 14 months ago. It can't have changed that much, right? And I think that's coming from a psychological phenomenon, which is essentially like, a fear, like a risk aversion, a fear of risk, or a fear of loss, I should say, a loss aversion phenomenon. They don't want to give up that equity that they feel that they still have, even though it's gone. And a lot of buyers, not all, but a lot of buyers are saying, there's blood in the streets. Pricing is not where it is today. It's where it's going to be in 3 months or 6 months when we close. So that just furthers that market dislocation, that bid ask spread that you referenced before. So, I will tell you that in any market, there's always buyers, and in any market, there's always sellers. So long as this industry has existed, there's always been a real estate closing every single day of, day of the week, a day of the year. So, I look at this as, it's our job as brokers to uncover motivation and to uncover motivated sellers. It might be a little bit more difficult now than it was a year ago. We may have to, turn over more rocks in order to get the same number of motivated sellers. But people are out there who need our help, and people are out there who need our services. And, it's our job to continuously be there for our clients. And what I tell everyone right now is, there's never been a time where it's more important to get an evaluation of your property. if you're an investor and you own commercial property, you own net lease assets, you need to know what it's worth. And there's been a lot of changes recently. So that's why it's important to reach out to someone like me who can help provide you with that analysis and give you, that help you with your strategy, give you that information so that you can make an educated decision.
Exactly, yeah. And so what you were just speaking of is the BOV, the broker opinion of value. So that's where a property owner can go to a broker, and the broker is going to provide that market expertise. You're going to be able to discuss, the cap rates and just kind of market sentiment, and also develop an exit strategy. Like everybody that's buying properties, one of my mentors always told me, like, you need to buy a property with the exit in mind, or pursue a partnership with an exit in mind as well. And that's where a broker can really come in. I think a lot of people, especially if they're doing like a single family house, they don't want to pay those fees and commissions to a realtor. And they might be able to understand the market well enough to be able to do that, and it'd be okay. But when you're playing with millions of dollars and really large commercial properties, you really do need to like lean on other people's expertise as well. And that's where brokers can really come in and offer guidance.
100%. And to that point, especially in commercial real estate, the value that a broker provides far exceeds the commission that they charge, right? It is very difficult for somebody who's doing something other than full-time brokerage to sell your property at top dollar with the best terms and the best buyer possible, right? That takes skill, that takes relationships, that takes time and energy, right? So, I even have many clients who are brokers themselves, right? They run a business, maybe it's a property management business, they have their broker's license, but they still use us to sell their properties because they don't want to be taken away from what they're doing to sell the property that we're working on. They want to focus on whatever it is that they do that brings them the most dollars for their time. So, if you have a property, first of all, if you want to know what it's worth, that's free. That's something that's a service we provide to all of our clients whenever they want it. If you want to sell a property, selling a commercial property without a broker is, I don't know why someone would do that unless they want to make their life very difficult and get less money.
For sure, yeah. So what is a typical fee that you guys charge for a sale of a property?
It all depends. There's so many variables. I can't really give you a broad answer for that. I can give you a broad answer. I can't really give you like one specific number, but typically, depending on the value of the property and the difficulty of the assignment, it's somewhere between 4% and 6%.
It's awesome. Yeah, that's good to know. So speaking, let's go a little more granular into the triple net investing and those types of properties. So can you tell us how those deals are structured? What are typical like return metrics, for somebody on the acquisition side, with a value add multifamily play? We might see like a 1.85 to 2.15 equity multiple, maybe like 15 to 18% IRR. What are some of the, let's say like a retail property, what are those return metrics? And then, maybe like what's some of the risk versus returns
Sure.
differences?
Sure. So for the purposes of our discussion, I'm gonna break it up into two different types of property, right? So you've got your single tenant net lease property. That would be a freestanding building that has one tenant who occupies the building, as opposed to a multi-tenant retail, for example, which is, let's say, a 20,000 square foot strip center with 10 tenants, right? So we'll talk about both of them, but I just want to separate them for the purposes of our discussion. So first, as it pertains to single tenant net lease properties, the cap rates can vary significantly. We can go through the spectrum just as an approximate value of where properties stand today, and obviously we know that that's subject to change. But on the very, very low end of the spectrum for net lease, you still have those Chick-fil-A's that are trading around a 4 cap. Those might have been 3.5 cap deals a year ago, but they're trading around a 4 cap. The Chipotle's also low 4s to mid 4s. Sometimes they can hit a 5% cap rate. And again, if you've got a Chipotle with a brand new lease with 15 years, it's going to trade at 1 cap rate. If it's got 2 years left on the lease, there's going to be a significant discount or a significant increase in the cap rate. As you get more into like the 5% cap rate range, staying on that theme of restaurants, you might have like a 15 or 20 year Taco Bell with a really strong operator in a good market outside of California or maybe parts of Florida, that's going to trade in the low 5%. There are still some great deals, 10 or 15 year fast food deals that trade in the 5.75 or 6 cap range. Now, just keep in mind, for whatever reason, quick service restaurant, which is that category of those, fast food restaurants, those cap rates tend to be pretty sticky, and they haven't changed nearly as much as some of the other assets, like, for example, dollar stores, which we'll touch on in a minute. As you get into like the 6 cap range, now you've entered more into the dollar store category. So the dollar store category, you might have some, properties that are trading in the low 6 caps, 6.25, 6.5. And some of those properties that were trading, a year ago at a 5.15 cap, now might be at a 6, 6.25. So that's some significant spread in cap rate, over a very short period of time. As you get typically more, and then again, I left out pharmacies. Pharmacies can trade, anywhere in the mid 5s to the 7% cap range. All of these deals, if you find a deal that has a very short term or has what we call some hair on the deal, maybe there's something, that is unusual about it, those can all affect cap rates. And you might see pharmacies or certain fast foods trading in the high 7s. I have a fast food restaurant right now that's, under contract in the high 7s, and that's because there's, a year and a half left on the lease, and it's a very small operator that's running that location. Typically once you hit the mid 7s or 8% cap range, anything above that, there's going to be significant challenges that the deal presents. For example, I have a CVS pharmacy I just listed at a 9 cap with 4 years left on the lease. That would have been a much lower cap rate. However, we know there's a very strong likelihood that CVS is going to vacate at the end of the term. So that's why the cap rate was so high. If you're an investor looking for a 10, 11, 12 cap single tenant, deal, you're probably not going to find it. And if you do, you probably won't want it. I tell people, when I talk to people and they're looking at a deal that's like 7.5 cap, and they're like, yeah, I need something that's 7.75 or 8 cap. Often I tell them, I say, is it worth the additional risk, and potential pain to, get a deal that has a 25 or 50 basis point higher cap rate? If the answer is yes, fine, let's do it. But I really want you to think about it, because oftentimes it's not worth that extra risk. Now, as it pertains to shopping centers, those, vary in cap rate depending on location, in terms of the actual market that they're in terms of their visibility and traffic counts in front of the center, as well as their proximity to other assets. Like the same shopping center that is, in a cornfield is going to sell for a lot less than a shopping center that's, adjacent to a Meijer or a Walmart or a Lowe's or a Home Depot. But generally speaking, the cream of the crop shopping centers might trade in the high 5s or low 6s. But most of the shopping centers that we deal with, the cap rate is around 7 to 9%. I would say the majority between 7 and 8% right now. I have a shopping center I'm going to be listing right now that's going to be at an 8 cap. But it's more mom and pop tenants, in kind of an older area, part of town. So yeah, I would say that's just, a general overview. And then, as it pertains to other deal metrics, obviously, if you want to calculate different types of returns, they're going to be based oftentimes on financing. So I can't really go into that without knowing what someone's, how qualified of a buyer they are, what rate we can get, what kind of amortization there is. And that's something that's changing today. Being that lending rates have increased significantly, right? They've gone from, let's say, roughly 3% to maybe, 6.5% in a very short period of time. We're watching lenders become more creative, right? So the same deal that might have had a 25-year amortization, now they might offer a 30-year amortization. And what that does is it helps. And by the way, what that means for anybody who isn't aware, most commercial loans have a 5, 7, or 10-year term, which means that the loan is actually due after, let's say, 5 years. But your payment is not based on paying down the entire loan over 5 years. It's based on a 20-year period, a 25-year period, or a 30-year period, and that's called the amortization. So in this example, you might have a loan that is due in 5 years, but the amortization is over 25 years. So at the end of those 5 years, you haven't really paid down the loan much. However, what the longer amortization does for you is it allows your cash flow to increase, right? So a loan that has a 25-year amortization is going to have a higher monthly payment than a loan with a 30-year amortization. So many investors opt for a longer amortization so that they can have a lower payment, which then increases their cash flow.
Yeah, definitely. And so to kind of piggyback off of that, those shorter term loans with longer term amortization periods, those typically have like a balloon payment at the ends where all of the money is due, so sellers are operators are motivated to refinance or sell the deal, or pass on that loan, a loan assumption, and give that loan to somebody else, before that payment becomes due.
Yeah, and that's why there is a lot of opportunity. First of all, anyone who has assumable debt, right, that makes your property instantly become more valuable. So if you have assumable debt and you want to sell your property, there's going to be a premium that people will pay for it. Now, in addition to that, what we all have to consider is that I believe there's a lot of opportunity coming up, because all of that debt that was sourced in 18, 19, 20, 21, 22, a lot of it has 5-year balloons, as you alluded to, right? So that debt is going to come due soon. And when those operators and owners and syndicators, whatever they are, when they go to refinance, they're going to get hit with like some ice cold water to their face, because either they're going to have to understand that they'll be cash flow negative because of the higher debt service costs, or they might have to bring cash to closing, right? They might try to refinance that property, but need to bring cash to closing in order to adhere to the lender's standards of, like, for example, their loan to value ratio or their debt service coverage ratio, which are important metrics for the lender. So that's gonna create some market activity, and I believe that that's gonna create some opportunity, because people are gonna be in a position where they're kind of gonna have to sell, not because they want to, but because they have to.
Right. Yeah. And to add more to that, there's a lot of people that I'm hearing in the marketplace that are owning properties. They got them, in 2020 or 2021, and they're having to do a capital call. And so that means that they have gone back out to the investors. So they raised all the money. The investors had a certain amount of shares, a certain amount of ownership, and typically, they don't have to infuse any more money into the deal. But what you're seeing is that the debt service is going up, and the property are becoming cash flow poor or even cash flow negative. And so they're having to get more money from investors, and investors don't have to do that. If they don't do it and other people choose to cover that, then their ownership of the property is diluted, and so their returns will go down. If they choose to input more money, that's costing them money that they could put in other deals. And if nobody chooses to, then likely the owner will have to sell at a discount or be foreclosed on. So like you said, a lot of people that I talk to, especially people that experienced the great financial crisis in 2008, 2009, a lot of them are sitting on the sidelines right now, just waiting, because they know that's going to start happening pretty soon. They know there'll be some really good deals, and people with a lot of cash will be able to capitalize on that. But what I would say and is there's never, like, you shouldn't sit out, of any market cycle. There's going to be good deals, like you said earlier, in every market cycle at every time, and we're already starting to see distressed properties come up and people be foreclosed on. It's unfortunate for those operators. They likely will never be able to be in the space again. And it's unfortunate for those investors that are losing their money, but that's a good thing for buyers and people that want to be investors right now.
Yeah, there's always opportunity. Like I said, there's deals in any market. There's buyers and sellers in any market. You just have to stick to your fundamentals. And I think that you brought up an important point. There were a lot of syndicators that came out of the woodwork the last few years. I feel like, and this is not a knock on syndicators in general, but everybody and their uncle became a syndicator, and a lot of people got into deals that maybe made sense right now, but that won't make any sense with any form of interest rate correction or market correction. And that's kind of the nature of our business. When I was in title, the owner of the title company always used to say that all of the burden falls on the last person who's holding the bag, right? So a lot of people who got in at the top are the ones that are holding the bag. And eventually what happens is the foundation, shifts a little bit and things happen, which everybody knows there's a lot going on right now. And that bag gets passed along to the next person who, who's the buyer at the beginning of the next cycle. So, that real estate is cyclical by nature, and that's what happens. So, we should expect this. What I will say is that it's important for anyone underwriting a deal to take into account, if you're going to hold it for any length of time longer than your debt is due, you have to underwrite for potential changes in interest rates. And yeah, I mean, I don't fault people as much as I would in other markets, because this was a drastic interest rate increase. But what I will say is that the government printed $10 trillion worth of currency and handed it out, right? And it's simple laws of supply and demand. Way more supply, oversupply of cash equals less value. So when there's less value, that means there's inflation. And when there's inflation, according to the way that this country is run, in order to get around that, we choose to raise interest rates. So when rates were artificially low for so long, and so much capital is being flooded into the market, into the public, and into private sector, I think that it goes without saying that people who were doing deals then should have been aware of the fact that interest rates were going to rise.
Absolutely, yeah. And when you're in an environment like that, when cash is flowing, so cap rates are also a measure of the sentiment of the market. And so obviously, like, people want to get in, they're seeing people make money and syndication, so they're willing to pay more and more and more. And so that compresses the cap rates and,
Yeah.
you know, I mean, honestly, like, potentially artificially inflates the actual values of the property because people are willing to pay that. And over the last several years, we've seen people make millions that honestly probably aren't qualified and, won't do good in this next part of the cycle.
Passive investors in real estate are able to receive a check every month. Some people call that mailbox money. We say money really does grow on trees. Visit the website at biggerpictureholdings.com, where we have a ton of free resources to help you learn more about planting your very own money tree.
So man, so last two things. What's a lesson that you've learned? Maybe something that you wish you would have done differently, or a case study of a bad deal that you've seen and some things to take away from it.
Yeah, so a lesson that I've learned, ironically, I just posted about it on LinkedIn. It's based on a fortune cookie. I post a lot on LinkedIn, and if anybody wants to, take a look at it, you can take a look, there. I'm obviously Dan. It's my first name, last name is Lewkowicz, Lewkowicz. But essentially the fortune that I got, I have it here on my desk. I got this fortune last night. We had a fit little family event. It said, "Don't wait for success, start ahead without it." And I can tell you this, like, I have had big successes and I've had big failures, right? I don't look at them as failures because they were learning experiences and because I kept going. But the one thing that I wish I would have done differently in my cycle of life was get it together quicker after a downfall, right? Because like this fortune says, right? Don't wait for success, start ahead without it. Even when things feel bad, even when a person feels like they don't have a chance in the world at something, you can't wait around. You have to make success happen just by starting, just by going, right? So for me, what I found works the best is when I'm in a little bit of a rut, is to just focus again on the fundamentals. What can I do and what do I do that will create success? It might not feel good today, might not feel good tomorrow, might take a long time, but if I keep doing it, it's gonna happen, right? So the learning lesson for me is to minimize that time between when things are going great and then they're not going great to when I start pushing to make them great again. That I would say would be like, the biggest learning lesson for me personally. I also think just in general, it's something that I observe, is that it's very important when analyzing deals to stick to your fundamentals and to not let emotion lead the way, right? Logic has to win, especially with, an analysis when it comes to a fundamental, like an income generating or potentially an income reducing investment. It's very important to stay logical. And then, I found also it's just surrounding yourself with great people, people who are a few steps ahead. I try as best I can to always reach up and at the same time make sure that I'm available to reach down when someone needs something. So really, I think doing my best to be a part of that framework of helping other people and being helped by other people, just giving and getting, I think is very, very important. And then the other thing I'll say is, like, it's important to invest in yourself, whether that's in a course, a mentor, tools that help you do your job better. It can be the simple things too, right? Like a person could have an outdated computer or a tiny monitor, and maybe with a $500 investment in their office setup, they'd be more efficient and less strained and less stressed. There's so many different things. A more comfortable chair, for example. There's so many different nuances where a person can invest in their self, and it feels good. It's a good thing. It's a really good and important thing to take care of yourself. That's number one. That always has to be number one, whether it comes to personal life or to business. It's like they say, when you get on a plane, you have to secure your oxygen mask first before assisting others. And that's really true in life. Like, a person can't be there for their significant other, their children, their friends, their coworkers, if they're not there for themselves.
Absolutely, man. Yeah, man, we could have a whole episode just on what you just unpacked. You brought up fortune cookie. I got one the other day that I thought was pretty funny, and I don't put a lot of faith in these, but it said you will get a great deal on a major purchase. So I'm fingers crossed. We get another good property pretty
Did
soon.
it come with a coupon for more Chinese?
I wish. Man, so you said you talked about just investing in yourself and courses. I know you created a course previously, and would love to just have you share what that is, and how people can receive that.
Sure. So it's called the CRE Pro course. Our website is creprocourse.com. That's CRE, like commercial real estate, procourse.com. And it is essentially a training course to help people who want to get into real estate investing and brokerage. It's really a soup to nuts, A to Z. We teach you everything you need to know, in terms, including the basics of the terminology and jargon in the industry, how to database, how to cold call. We actually give you cold calling scripts. We teach you, how to handle deals, how to get deals through escrow, how to market your properties. It's a really great course that has thankfully helped a lot of people get into the industry. And it's something that I did because people were reaching out, constantly on LinkedIn. I was having maybe 2 or 3 phone calls a week from people who wanted to get into the industry. And I figured there's a need here. Let's create an actual course that can allow many people to access, that training, at one time. So, that's what it is. Was a very fun venture for myself and Zach Rasinger, my partner. And, I would love for people to take it and find value and, accelerate their career.
Absolutely, yeah. What's the cost on that course?
The cost is $497.
Okay,
And
awesome.
there's 28 modules. You get 90-day, on-demand, unlimited access. And it's really great. It's definitely
Yeah,
going to
that
be an investment.
that sounds really awesome. I like that a lot, man. So last thing, I just want to shine the spotlight on you. I want to hear your proudest accomplishments, whether that's with real estate, whether that's with your family, just whatever you want to hype up, Dan.
Yeah, so I guess I'll do both. Family first. I have 5 kids,
Wow,
and
that's awesome.
yeah, I think the thing that I'm proudest about is that like, my younger kids aren't there yet. They're all great kids, but my oldest actually turns 14 tomorrow, which is absolutely insane for me to even say, because obviously time flies. But to see my kids just, like, stepping into life and being good people, and being inquisitive, and having that spark, that really makes me proud. I mean, when I talk to my kids, and, like, I feel that connection with them, and I can kind of sense that hustle and that charisma and that energy. I think about, like, what, you did a good job. You know what, even if it was just by osmosis, just by our interactions together, they kind of got some of that. They got some of that stuff that I love about myself. So that makes me really proud. And I am so proud of my kids. I am so proud of them. They're great. They're just great people. And I feel like, it's a huge blessing to have them in my life. So that would
Definitely.
definitely be my my proudest accomplishment. As it pertains to business, I mean, I think just in general, just being here, just continuously grinding and hustling and doing deals, that's an accomplishment in and of itself. I did something pretty incredible last year. I was able to list, procure the buyer, and successfully close on a transaction that was close to $50 million, set a record in Traverse City. That was amazing to be a part of, to be a part of a transaction that had, like I'm just looking at the numbers, the 30 some million dollars worth of loans. It was incredible to be part of that, and really, to feel like I was assisting and helping the family that was selling it to transition to another, part of their life, from active, management and ownership of certain assets to, more of whatever the next stage for them, includes. So that was amazing. That was really amazing to be part of. And it's not far from where I live. It's maybe 3.5 hours. I've been there maybe once or twice since I sold them. Obviously, I was there a lot when we were in the marketing process.
Definitely.
But to go by and just to see these huge resorts on the lake, and to know that I was responsible for that transaction, to me is amazing. It's really amazing. And I've been every year that I've been at this company, I've been the number 3 producer in the company, and to me that's an accomplishment in and of itself. And just but I want to make it more general. Just being here and thriving and continuing, and like there were so many moments along the way. Like I could tell you so many moments where it was like, oh man, I'm flipping tons of houses. I don't know, I've got all these things going on. I've got all this inventory. I'm managing my crews. I have equipment. Like, what am I going to do? And then, having to pivot and figure it out, right? There have been so many moments in my life where I had to pivot and figure it out. It has not been all like, amazing glitz and glamour and all that shiny stuff by any means. So for me, just to sit back and look back and say, you know what, you did it. You kept going, you didn't wait for success. You started ahead without it. Right. So that for me is a huge accomplishment.
It's awesome, man. Well, Dan, it's been great to hear more of your story, and we appreciate having you on today.
Thank you so much. I appreciate you having me.
Like and subscribe below. A new episode will air every Tuesday at 7 a.m. Are you looking for more content? Visit our website, biggerpictureholdings.com. And remember, money really does grow on trees.